let's talk about financial statements and cash flows with kind of an eye that, hey, if you're going to buy my overall argument that, let's even put it this way, right? That corporations are different, unique, in large part because of that passive ownership, right? And that passive ownership, run out of room, via stock. And it's a very natural thing to wonder then about, well, how would you come up with a value for this investment, this stock? And the reality is, stock is it's an investment in the purest sense. It doesn't have any other utility other than as an investment. You can't eat it, wear it, sleep under it. It's no fun to look at. So the only reason you own it, the only reason it has value, and this is the stock price today, is PO. The O is a 0 there. Well, it's based on the cash it'll pay in the future. So we often say, well, free cash flows, but free cash flows that are in the future are not worth the same as a dollar amount today. So if you were to get, say, $100 free cash flow 1 year from now, put like 100 here, well, it's not really worth 100 today. It's worth a little less than 100 based on whatever interest rate you're going to discount it by. So you might, if it's 10%, then it's really worth closer to $90, that sort of thing. We'll get much more into time value of money later, but again, the only value from this really important passive ownership structure would be from free cash flows. Well, then wouldn't it be nice to come up with some kind of way to measure or value free cash flows? The first place to start doing that is via financial statements. Now, there's certainly some rules, some mathematics, some straight up accounting that contributes to trying to measure free cash flows. There's also a little bit of difference of opinion and different ways to try to measure free cash flows, even via financial statements. But we're going to take a shot at that sort of thing together right now. Right? So, finance focuses heavily on valuation. Well, valuation in the case of the stock would be based on all these free cash flows. We're going to talk about some other instruments, for example, like bonds later. And the value of a bond is going to be based on all of the cash flows that it pays back to the holder because it's, again, a pure investment. It has no utility other than cash flow it will provide later. From the company's perspective, we can talk about things like the value of a project. But the reason that you do a project, like create a new product, open a new plant, expand to a new market, et cetera, is to generate, again, cash flows sometime in the future. So getting some kind of feel for value is going to be based on getting some feel for cash flows. The stock example here that I'm writing out is one way of thinking about it, but that can work with other things too, again, like bonds, projects, etc. The first place to go looking for information about cash flows is from financial reports. The biggest financial report that you could ever think of would be the annual report of the stock, right? Say your financial statements there provide, as the book says, a method of keeping score. Right? You can see how things are moving on the financial statements. And the annual report is only one of them. It's often called the 10K. Right? Well, the 10K at least is the financial part of the annual report, the financial statement part of the annual report. But you'll sometimes see or hear that abbreviation or that kind of shorthand used interchangeably with the term annual report. Right? There's other reports too. There's quarterly items of all kinds. There's certain revisions and things like that. But the annual report is a really good place to start when you're talking about financial statements. For one thing, it's kind of the big, publication of all of the information simultaneously, where you can get kind of a good measure of different financial items. Right now, the annual report doesn't just have financial statements. It tends to have a bunch of other funsy things in it too. It's kind of part advertising, especially off the top. I mean, for fun here, I just picked out the McDonald's 2007, so I'm going back a long time, annual report. And this is not unusual. Usually there's glossy, pictures to the start showing you how wonderful, right, a company is. I know when I go to McDonald's, it's for the apples, right? And a lot of happy speak about our customers, and a lot of times about charity, involvement, stuff like that, which talk about agency stuff back in our previous section, right, is charitable giving, if you want to be super cynical, might make the CEOs and the upper management feel good. How do the everyday shareholders feel about, has somebody else deciding how to spend? If I want to give to charity, maybe I'd rather pick the charities myself. Okay, I'm getting too cynical here, but it's very common to have, again, letters to the shareholders, discussion of all these, pump you up things about the company, and then eventually, right, more branding stuff, highlights, etc. But eventually, when you get past the glossiness of an annual report, I promise it's coming, right? You get to the financials. Whee! Right? Practically speaking, it's somewhat common to see your income statement type thing first. It's also common to see a lot of them side by side to allow easy comparisons. That's a really common thing with financial statements too. Usually you don't just look at 1 year's. You have them chronologically, and typically in this fashion with the most recent one on the left. And it's very common to see your income statement type first. Sometimes it's called different things, operating statements and such like that. And then usually you'll see some breakdown and discussion of those items. Eventually you'll get to, right, there's even a more consolidated version of an income statement. Eventually you'll get to some kind of I promise, balance sheet. Ooh, extra information about for exchange rates because McDonald's does a lot of business overseas. Right? These are kind of more supplemental things. Right? Describing in detail the various parts of the income statement. You still have stuff like discussion of SG&A expense, really funsy stuff, right? ROIC calculations. But I promise, there it is again, another version of income statement. Finally, we get to a balance sheet, okay, which is weird because normally when we discuss financial statements in an academic setting, we usually show the balance sheets first. It kind of it's easier to teach it that way, frankly, because the income statement kind of serves as a bridge describing the changes from one balance sheet to the next. So it might be really common to do something like, again, have a 2012 balance sheet, with assets on one side, liabilities and equity on the other, and compare it. And actually, to be frank, usually the L&E is just all underneath it. So we might call it left-hand side and right-hand side, but it's typically all just in one column. And then you have the same thing here, right? And then when you have this is usually year-end, and then you'll have a 2012 income statement or revenue. There's all sorts of names for them, operating statement, etc. That kind of describes the changes from the 2011 levels to the 2012. Right? So even though you lead with the income statement in the real world, it's somewhat common to see balance sheets first when you're discussing these things in a textbook sort of setting. Yep, the verbal portion, right, is just as important as the numbers. They're not talking really so much there, the verbal part, in terms of the funsy ads and the pictures of the apple slices. And normally what they're really alluding to is all of this text here. This can be some dry reading, right? But if you're a true financial analyst, a true investor kind of thing, this sort of stuff is actually meaningful. So not just the numbers themselves, but the description of, well, in particular, why might they be unexpectedly high or low? Is there anything unique about this year that makes this a one-off as opposed to potentially part of a new trend? So the discussion here is really important too. It's thick reading, typically speaking, so not many people want to do the hard work of reading it. You have to have the combination of the hard work, the grunt work of reading something dry, along with the talent to interpret what you're doing. A lot of that comes with experience as well. But you get a lot of information for this. These reports, right, your auditors and your company upper executives are swearing to the truthfulness of these things. So some of the explanation here, while sometimes veiled or careful or this or that, right, will ultimately, you can't be deceitful, right, with these sorts of things, because that would be true violation of law, right? So the verbal portion, quite important. And then, of course, we're finance people, a lot of overlap with accounting, as discussed last section. So you got to have the numbers themselves, right? A typically statement of the income statement usually comes first on an annual report, even though we talk about balance sheets first, as we do right here. Right? Remember, right? Liabilities. The book too is a little bit sloppy in my opinion with liabilities and debts. Debt to me again is always interest bearing. When you see the word debt, right? That comes with interest owed. Not all liabilities are debts in my world. I don't use those things interchangeably, but you're familiar all with the fundamental accounting equation, which is all of your assets are backed by either liabilities or equity so that this sum, right, the sums, excuse me, on either side are equal, right? This is often described, we discussed this a bit back in the first section, in terms of order of liquidity. The things that are closest to dollars of cash comes first, right? So cash in the company checking account is the first asset, right? And then things like accounts payable, right? Bills that you have to settle very soon in cash will be your first kind of liability when we go to, right, the right-hand side of the balance sheet. And then, so after you kind of list things in terms of liquidity, right, for the current case, things that are, right, kind of either going to have value within a year, cash value within a year. It's typically 1 year is the current threshold, although that's not something I exactly test on. Right? And then you have underneath it the less liquid fixed assets. Those can be tangible things that you touch, like your fleet of vehicles, your property, your buildings and stuff like that, or it can be copyrights and patents and things like that as well, intangible assets. Those things tend to come to the bottom of the left-hand side of the balance sheet, or at least the bottom of the asset portion, right? Liquidity here, of course, is the quickness with which you can convert items to cash. So when we say that you have assets listed basically with current things first and then more fixed, it's again saying that you're basically listing the balance sheet out in order of liquidity. Right? The value of assets, right, is going to be based on historical cost. Right? And in some ways this is good or advantageous. In some ways it's bad. In some ways it's misleading. But if you own a piece of land, for example, as a company, and you bought it for $1 million, right, then you might keep it on your books at $1 million, even if you've held it for 20 years and it's worth $5 million now. So in some ways, values of assets can be misleading. Right? They can be misleadingly low. Right? They could also be misleadingly high, right? But that's why we depreciate the value of things that have a life cycle, sort of thing, right? That feels good. That feels good in some ways, right? To have the value higher, but it also feels bad, and it has a big impact on things like taxes, right? Because taxes are often based on accounting rules rather than market values, kind of thing. So when I say value of assets, to me, the value of assets, right, on accounting statements are often called book values, to kind of note that on the books, this land is worth $1 million. Book value. So when you see something like the book value of an asset, the most common thing is the book value will be less than its actual market value, but not always. So say the actual value of assets if sold could vary tremendously, sometimes not. And that can make for a really weird thing when you're trying to value a company, because when you do things like just stare at the balance sheet, it might look like, oh, the value of the equity of Coca-Cola is $1 billion, right? And there's 100 million shares, so each share should be worth $10 million or $10. Well, not exactly, because when you own a share of stock, remember, you own future cash flows that are coming in, not just what you have right now on your accounting statement. So again, this is kind of an example of where the difference between accounting and finance. In finance, there's really nothing that we care about more than the value of things. Right? Although assets are all stated in terms of dollars, only cash is represents actual money available to be spent. Now, sometimes, right, you have other things like holdings in short-term money markets and such that could really quickly become cash. So sometimes you'll see entries on corporate balance sheets like cash and equivalents. I don't really remember if McDonald's had something like that or not here in its breakdown. It's somewhat common to do that. Let's see what it says. Cash and equivalents, yes. So it's not all cash has to be in a checking account, and it's certainly not currency sitting in a McDonald's safe or anything up on the 50th floor of the headquarters. But you get the idea. Practically speaking, it's super close to cash. You need some kind of cash and equivalents to quickly address liabilities that are coming due soon. Right? A few little shorthand just in case you forgot or hadn't seen them in a while. Right? Receivables are things you are owed these. Right? If I'm in the Coca-Cola business and I just shipped, a whole truck of product, right, to Walmart for wholesale or for them to retail, right, then Walmart might not pay me immediately. I might have, they might owe me $40,000 for that truckload of beverage sort of thing. Well, that's an account receivable. It's not cash, obviously, because I haven't collected it yet. You're darn 99.999% going to, but until the cash is in, it's a receivable. Inventory are ready-to-be-sold products. Right? Ready-to-be-sold products. Right? They come only at the assembly value. So if you say you have $100 in inventory, that means that you assembled something where the parts cost you $100, right? But you will hopefully sell this thing for $150 or $200 or $300, and that's what eventually will offset some other expenses that aren't directly tied to cost of goods sold sort of thing. Of course, not every company is a manufacturing type company either. Net plant and equipment reflects the amount of the firm paid for its fixed assets minus accumulated depreciation. That can vary quite wildly depending on what sort of fixed assets that you're dealing with. It's also really common, in my experience, for plant and equipment to mean the same thing as fixed assets, because there's a lot of accounting type terminology that sort of relies on a 1950s version of a company. So fixed assets is a more general term, but your fixed assets might be, large computer systems rather than a plant that makes cars or widgets or soda or anything else. This is a common setup of an asset version of a balance sheet. Again, you usually have the more recent year on the left, and it's stacked as a column next to the previous year on the right. And that allows for really quick comparisons when I see things like, oh, my cash balance is down. It's only a third-ish of what it was last year. And you might have to read the verbiage inside the report, the annual report itself, to get a feel for, well, why is that the case? Is this okay? Is there some story behind this sort of thing? What other you have? But you have more long-term investments here, not a lot more, but some, right? Goodwill and other sorts of intangible items are things that we'll discuss a little bit more later. The idea there is trying to put some sort of accounting value on things like your brand name and such is not necessarily the easiest thing to do, and it's more of an upper level accounting sort of topic, but it's something that we might hit a little bit more later depending on how things go. We're talking now about the right-hand side of your balance sheet, right? Your liabilities, which again are typically listed in liquidity order. And while again, traditionally the setup here of a balance sheet is something like, assets on the left-hand side, I'd even call it LHS traditionally, and liabilities plus equity on the right-hand side so that it balances and makes you a balance sheet. Normally what practically happens is you actually have your assets all listed out and a grand total of total assets. And then you have your liabilities underneath, right? Total liabilities, and then your equity, total equity, and then there's a grand total at the end of liabilities and equity. And it's usually all done, like, again, in one sort of column with things by year, say 2014 more recently than 2013, et cetera, et cetera. The equity accounts indicate, equity accounts indicate the amount of funds shareholders have contributed to the firm. But remember, this is another example of book value, right? The book value of equity and the market value of the company, including its its shares of stock and such. The book value of equity and the market value of equity, book value of equity, are not the same. And a lot of times they're not even close. It's going for red. Not even close, sort of thing. Your book value of equity, like, hey, we all kicked in $1,000 to start this company. That's right. That's our starting equity. And then we sold units where our expenses were 100. We sold them for 200. So we credit both cash, say, and retained earnings for 100, sort of thing, right? But the value of the company is helped, like we talked about in the first section. The more profitable the company and the higher the retained earnings go, that generally makes your, right, generally as those things improve, then your market value improves, and vice versa, generally. But ultimately, the market value of a company can be anything. It can be whatever people think the company is worth, and that should be based not just on what you have on the books right now, which is often done in accounting terms, but on future free cash flows that haven't happened yet. And since they haven't happened, you can't put them in, right? You can't put them in the accounting statements, the book values yet, but they're a big part of the value. And the reality is, when I've given you shorthand before about this intrinsic value and it being in future cash flows, usually you also add up, right, the current cash that's already there. And you don't need to discount that since you already have it in today's dollars. Okay, so say book value versus market values kind of thing. And I say there's all sorts of arguments, and we'll talk more later in the class about whether there's a magic amount of debt versus equity that companies might shoot for, right? Some businesses, it's really common to have high margins of debt. In banking, right, most of your assets are backed by money that you actually owe back out to others, and you have a relatively small piece of net worth or equity in a banking world. In something like a pharmaceutical company, you might have very little debt. Right? Might not be many people willing to loan to you because you're in a very risky venture, and you might have a lot more stock, sort of thing, a lot more equity. Right? If things were to go south, if you were to go bankrupt, your creditors would have the first claim to your firm's cash flows. Right? So that sort of thing works as you might expect. Those that are formally owed money via a contract, right, your creditors have a formal contract with the company, would get paid first before the shareholders have anything to split up. If a company's going bankrupt, usually the shareholders won't get much of anything. That's kind of the point. Otherwise, they wouldn't be going bankrupt. If you're doing something like liquidating a company or making a potential move to go private instead of public or things like that, then the shareholders would potentially have some kind of residual value. And we say again, market value of equity is the market value of assets less the market value of liabilities. Sort of, yeah, in comparison. But my biggest thing, the book likes that discussion, but my biggest thing in discussing that's true, but my biggest thing on this is noting that there's a huge difference between book values and market values. Right? The retained earnings is where you typically see the accounting version of your equity, most of it. You'll have some common stock often in the equity part of your balance sheet, but usually the common stock on the balance sheet only reflects the book value of the initial stock purchase. So it doesn't move unless you issue new shares or repurchase old shares. It's the retained earnings that hopefully grows every time you make sales and credit profit, right? Or other things. So you might also credit cash for your balancing transaction. You could credit other things on the asset side, but retained earnings is the thing that typically grows. Right? It would be oftentimes they indicate more cash available for use, but they don't always. Right? They don't always. That's only the case, right, where you're, excuse me, where you're kind of booking a profit directly, and all the profit was cash after expenses, sort of thing. So the easiest thing to kind of look at here is, again, a side-by-side comparison. Now we're looking at effectively the bottom part of a typical balance sheet with the years here side by side for easier comparison. It's typical, again, for the common stock not to move from one year to the next. The common stock on the balance sheet has nothing to do with the value of common stock on the balance sheet has nothing to do with the value of common stock out in the marketplace. The common stock on the balance sheet only represents what you got, what you raised in money for the stock when you first offered it to the owners. It's the retained earnings that's moving all the time, and typically up over time, but say you can have bad years and such. Also, when you decide to pay dividends as a company, that dividend amount usually comes out effectively of retained earnings. So your retained earnings might stay the same from one year to the next, for example, and it still could indicate a good profitable year for the company because you effectively took all of your profit that would have been credited to retained earnings and pay it out instead in terms of dividends. Right? Your income statement, say, again, even though we show it second here in like a book chapter, it's really typical with an income statement to see it first when you're actually looking at a company's 10K or its quarterly filings as well. Right? The income statement to me is sort of the negative Nelly of financial statements. It starts with the good news, the sales. Hey, we sold $8 billion of product, right? But then everything after that is, well, yeah, but you got to pay this. Oh, yeah, but you got to pay that. Oh, yeah, don't forget this cost. Oh, yeah, don't forget taxes. Oh, yeah, service your debt. And then at the very end, you're left with the profit, the net income, the earnings. Now, again, to me, profit can be a little bit more wiggly in terms of interpretation, but to me, when I hear the word profit, I'm actually thinking net income. Right? Now, that's a little bit more of my personal take. What's not my take, what's genuinely just true, is net income and earnings are the same thing. Right? So earnings is one of those words that you got to be careful with using. You don't want to use the word earnings in a financial setting willy-nilly. People say, oh, well, we're earning well. Be really careful with the word earnings. When people say earnings, they quickly jump to the idea of net income, right? Bottom line income statement value. So you don't want to use that in any kind of casual sense, that term, right? Now, corporations usually calculate income for two different ways, right? Reporting purposes and tax purposes. This isn't exactly keeping two sets of books, but what it is it's kind of recognizing that, as you might say, go back to the idea of book values. Hey, if you have, say, if you have an asset that you're allowed to depreciate, right? If you have an asset that you're allowed to depreciate, then you might write its value down and take that depreciation expense, right, against your company's earnings so that you can pay less tax. But just because your asset depreciated $10 million in value legally, that doesn't mean that it's actually worth $10 million less if you go to sell it. So you might be allowed to take an asset worth $70 million on the books and deduct $10 million of expense, of depreciation expense, and with that shield yourself from some tax that would otherwise be due on earnings. The reality is that doesn't necessarily mean that your $70 million asset now sells for 60 in the open marketplace. It might sell for 60, it might still sell for 70, it might sell for more, for 80. But that's just one example of the reality that tax matches up with accounting or book values typically. It doesn't always match up with values in terms of what you can buy and sell things for. Right? Examples there. Right? Examples there. So your top two lines in some things like again, most manufacturing, your cost of goods sold or cost of revenue, those are interchangeable. Cost of goods sold, cost of revenue are high. In other things that are more informational, there's very little direct cost of revenue. So COGS, or cost of goods sold, is the same thing as cost of revenue. And after you take away the cost of assembling your products, your sales, or total revenue, or sales minus your costs of goods sold or cost of revenue, is your top line profit, your gross profit. But again, with the income statement, everything's negative and chipping away, right? So yeah, but what about your R&D expenses? Well, you might not have huge R&D expenses if you're in something like Planters Peanuts kind of thing. You might have some, making a new strain, agronomy, different packaging, new cans. I don't know, but it's probably not a huge thing. Right? Most every company has substantial SG&A expenses. For one thing, there's a lot of different things that could be shoehorned into general, right? But there's going to be advertising, right? There's going to be certain payroll and things like that, right? So that's pretty common. Usually, most every company has a substantial SG&A line, whether or not it has a substantial R&D line, and then there can be some other piecemeal things as well. This gets you to an operating income or loss. An operating income or loss is the same thing as your earnings before interest and taxes. Right? So this operating income is yet another term, that has a very set meaning. So you wouldn't want to go throwing around the term, oh, my operating income willy-nilly. Because if you say operating income to mean anything other than EBIT, right, earnings before interest and taxes, you're making a mistake, or you're leading people astray. Right? So it would stand to reason then, yes, that after you take out earnings before, this actually, operating income, I say that, and 95% of the time it's true, and then I forgot in the book example here, right, that occasionally you'll have some sort of an adjustment line here, right? So income from continuing operations, total income, that doesn't typically happen in my examples that I test with, by the way. Right? So to me, operating income is synonymous with EBIT, but I guess I'm wrong. I guess there's actually the occasion where there's not a perfect immediate link. Usually it is, I promise. Subtract your interest expense, that gives you an income before tax. So income before tax is the same as EBT. Right? So minus interest is EBT. Then you employ or apply a tax rate, right? Interest tax expense, leaving you with a net income. Right? So again, this is sort of the negative Nelly. Hey, here's the good news. You sold $68 million of sales, but then pecking away for the most part, and that leaves you with $3.3 million in profit. It's kind of like panning for gold, where you have a bunch of sand in the pan, and there's a lot of sifting off of the sand before you get down to the actual gold, the profit, the nuggets in that analogy. Right? Depreciation is charged to reflect the cost of assets used in the production process, and it's not a cash outlay. So one big difference between value of a company and the accounting setup is that since depreciation is a non-cash expense, when you're going to talk about the cash flows of a company, you would actually use your depreciation as an accounting expense, right? Trying to think if we even have the... Right. We didn't have any depreciation directly here, did we? Use your depreciation as an accounting expense before you total your tax bill. Right? And then when you're calculating your cash flow, you get to add that depreciation expense back because you never had to pay for it in terms of cash. The cash outlay all came at the front when you purchased the asset, but you took the asset onto your books at the purchase price. This is all just sort of an overview of the difference between book values and market values. And this will really become somewhat obvious to you when you start doing some concept questions checks, along with reading your text for the full story, of course. Right? But doing some concept question checks and even some practice problems that I've got some assigned for you to try. And I've got the solutions that the book provides, as well as some of Dr. Best's favorites as well that he did for us. Right? There you go. EBIT, earnings before interest and taxes. EBT, earnings before taxes. And again, to me, and I guess to say I must be careful, I suspect, with that line, but to me, EBIT and operating income are synonymous. I suspect, I guess that's only true most of the time, though. Right? Your marginal tax rate is your tax rate for your next dollar of income. Right? So, okay, right, I've sold this amount, I have this much profit. I'm going to sell some more units today and book another $100 of profit. Well, I've already probably had a lower tax rate on some of my early profit, and I now have I'm in the 25% marginal tax rate. Well, my next $100, I pay 25 of them in tax. But my average tax rate overall will probably be less than your marginal tax rate, because usually your first $1 million of income is taxed at 5%. Right? And then your next $10 million of income might be taxed at 15% and such, so that your marginal rate, right, is usually larger than your average tax rate. A capital gain or loss on the sale of an asset has historically favorable tax treatment. That's to say that usually the tax code tries to incentivize investment, particularly long-term investment. Now, tax law changes all the time, so you got to be careful about the amounts and stuff before you quote anything, and you can always go check out more. You can get more information at any point in time for what the tax rates are. But a capital gain would be the idea of, oh, we invested in something for $5 million, we sold it years later for $20 million. Well, I owe tax on that $15 million of investment income. But you usually owe a tax rate, a capital gain tax rate, that's less than your marginal tax rate. You might be in the 25% tax bracket, but your capital gains tax rate might be something like 15%. That's to incentivize investing, and especially longer term investing. If you flip assets with under a year of time frame, that's usually a short term capital gain. If you hold them for a year or more, that's a long term capital gain. Right? Generally speaking, there's some favoritism to debt in terms of taxes. So it can be advantageous to borrow money to finance operations. That can be really weird to people when they're starting their study of corporate finance, because people think borrowing is bad, and borrowing is bad for consumption and household consumption, typically speaking. But there's a big difference between borrowing for production. Right? Now, that doesn't mean that it's always the right thing to do to borrow, even in a corporate setting. But there's a big difference in borrowing for a boat, right, where you're just consuming, versus borrowing in order to hopefully flip the funds for an increased profit. Right? So it's natural for people to think of borrowing as bad because of the things that it tends to paint you into corners as a consumer. But that's not necessarily the case with production. And in fact, with production, sometimes it can be beneficial to do so, because interest payments on debt are tax deductible. Now, they're not all tax deductible at the same rate. They're not all tax deductible, period. But generally speaking, your interest payments are tax deductible. So it can be cheaper, effectively, for a company to borrow. Now, what the reality is about this, where it's cheaper to borrow because your taxes are less with debt financing, and we'll get more into this when we get to our cost of capital chapters later. But the reality is, when you issue equity instead, yeah, it's true you don't owe any interest, right? So that's cool. But you're also now sharing the profits, right, or the dividends, to be more direct, the cash flows that come from dividends. You're sharing them with more fellow shareholders. So you're diluting the values of your shares as an owner. And so, yeah, it might stink to pay interest on debt, but it might stink even more to water down the value of your shares by opening or welcoming more fellow shareholders into the fold. Right? Depreciation plays an important role in income tax calculation. The larger it is, the lower your taxable income. So generally speaking, last thought on that before we move on. Generally speaking, right, this is why companies like to depreciate assets quickly. Right? Whoops. Firms like to appreciate assets quickly. That's a surprise to most people, and understandably so, right? But you get to save or shield the income from tax earlier. And you'd rather save $1 of tax this year than 5 years from now, because dollars today are more valuable than dollars in the future. We'll talk a lot more about that when we get to time value of money. It sort of just makes sense. Some of that's due to inflation, but there's other reasons as well. And so you get some interesting things going on here in terms of tax. And EPS, or earnings per share, is literally just your net income. So when I say being careful about the word earnings, this time the book agrees with me completely. Right? DPS, or dividends per share, is the amount of dollars of dividends paid out. But if you pay $8 million of dividends as a firm and you have 1 million shares, each shareholder gets $8 per share. Those dividends are typically paid out every quarter, so you might pay $8 or you might pay 5% dividends a year. If you have $100 million or 100 million shares outstanding, right, and you pay out $5 million in $5 million in dividends, 100 million shares, right? So everybody gets 5 cents per share, right? Well, usually it's split into 4 equal pieces throughout the year. So you might get 0.125 cents per share in April, another 0.12 or March, another 0.125 in June, another 0.125 in September, another 0.125 in December. That's just more a little bit of market trivia. When people talk about the book value per share, that's just your total common equity on your balance sheet. So that does not necessarily have anything to do with your actual value as a company. Your actual value of company is your total market value. And the way to get that is to just multiply, hey, my stock is selling for $35 a share, and there's 100 million shares outstanding. Right? Well, then if you have market value, the value of the company is supposed to represent what it takes to buy out the company. Now that's a little bit sloppy. Doesn't always tell the whole story, but it's close, right? How much would it take to buy up all the shares effectively? So if you had something like $35 per share, right, and you had 100 million shares, right? Now we're talking about a company worth $3.5 billion. This is also known as the market cap. The market cap for capitalization. So you'll say market cap for short, but market capitalization is the fancy way of saying the entire value of the firm. Not all profit and cash flows do not necessarily intersect. We talked about this a lot in our previous section. Right? Profit being an accounting term, typically linked to net income. Usually, the better that you do in terms of accounting profitability, the more cash flows that will be released to the shareholders, specifically in the form of dividends. But it doesn't always work that way. Right? There could be other weird things, right, going on, and companies might decide they don't want to pay dividends yet. Sure, they took in a lot of cash, a lot of profitability here on the books, but they're not ready to share it with the shareholders yet. They have bigger, better plans for it in the meantime. Right? So all sorts of things where those, like we said in chapter 1 or section 1, need not overlap. Right? For now, mostly just a plea, again, that when you're considering the value of the company, right, profit is interesting, but you really, that value of the company needs to be based on cash flows that will be generated in the future, right, as well as the cash that's currently with the company. So when you're actually talking about a valuable, what should Kellogg's be worth? It should be worth all the cash that it generates in the future, all corrected for or discounted to present day values, along with the cash that it has today, and then shared or split evenly amongst the shareholders. I guess I should be clear when I do that or say that that whenever I give you this kind of, you know, stock price talk, right, that the stock price today should be equal to the current cash. See, I'm getting more and more refined with this, plus all the free cash flows in the future that are discounted, right? We need to share these things equally. So this should all be divided. This is your price per share. Normally that's how you quote a stock price, right? So that means when you take all these dollars here, you need to divide by the number of shares outstanding to really emphasize the mathematics here. Your statement of cash flows is a helpful way to piece together how the accounting pieces, let's say in your balance sheet particularly, translate to cash impacts. It doesn't necessarily match up perfectly with the free cash flow estimates that I'm talking about from this kind of framework. So a statement of cash flows does not automatically output free cash flows measured, that you need for this kind of thing, but it's close and it's useful. It's a useful tool, right? The statement of cash flows in particular tries to give you some feel for the distinctions between operating, investing, and financing activities. Right? Operating is the lifeblood of what you do. If you're selling soda, like Coca-Cola, right, then it's, hey, I had this many sales. It cost me this much to employ people. It cost me this much for bottles, this much for sugar, this much for whatever, right? And those sorts of things are in your operating area. Right? Your investing activities are usually, I can't really think of great counterexamples, going to be a negative. It costs cash to embark on investing activities. So I have a hard time even imagining, I guess, investment income. I don't know. To me, even that's kind of a iffy, like financing activity sort of thing. So in my experience, most always your investing activities is going to be a negative impact on your cash flows because it takes cash to make investments, and that's what you're detailing there. Financing activities can be positive or negative. If you borrow, oddly enough, that's going to be a positive cash flow from financing. If you pay interest, though, on your borrowing, that's going to be, and you have to do it in cash, of course, that's going to be, right, a negative sort of thing. Right? In this case, net borrowings means you probably repaid some old debt, right, by $31,000 more than you took out new debt. Paying dividends is always a negative because that always takes cash out of the firm's coffers. Right? It's by definition a financing activity, so the decision to pay dividends comes after you've surveyed the landscape and decided financially you can afford to do so. And again, it's just kind of a convention. Right? And in this example here, you have a firm that made cash from its operations, but given some investment here, right, and given that you repurchased a bunch of your own stock in this year and paid a bunch of dividends right here and repaid some debt right here, you actually end up with negative cash impact in year 2. You generated cash with operations, but you used a lot of cash to buy back your own stock. We'll talk some more about that later in the class. Just to not just service, but to pay down your debt. So that's the reason for the overall in year 2 negative. You have a positive cash flow in year 1 because you didn't have as many financing activities that were negative, and you had an even more profitable operating year. Okay. We'll deal with interest in a little bit of a unique way. Interest expense, I alluded to it a little bit there, but interest expense is a financing activity, not an operating one. Right? So, but we will deal with it not directly in terms of cash flow, but we will bake it into the pie a different way. The reality is, right, when we start dealing with this sort of thing here, rather than having your interest expense decrease your free cash flows, what we're going to do with your interest expense is your interest expense is going to make this number in the denominator higher, and it's going to lessen the present value of these overall quotients. So we will deal with interest, but you don't see interest here listed, right, as a financing activity. right? And I should have been clearer about that a moment ago. But in general, say again, we're trying to make some links here with the accounting idea of profit, which is largely linked to cash flows, but they're not directly linked because you have to equate, for all sorts of non-cash items before you do so. A free cash flow is the idea. It's the perfect idea of what I'm talking about here when we're coming up with a value for intrinsic value of the firm. So formally from our book, it's the cash flow that's actually available for distribution. That's, of course, what the shareholders ultimately care about, right? The investors here want to have some cash available that they can share. They usually see it in the form of dividends, although there are other ways that sort of thing can shake out too. But that's why I say I'm very keen on this sort of expression of company value. And free cash flows here again don't always typically match up with the change in cash or cash flow here on your statement of financial. There's a difference between free cash flow used for valuation purposes and cash flow from the statement of cash flows. The statement of cash flows describes much better the link in the balance sheet between the cash the year before and the cash the year after, right? But it doesn't describe the market conditions in the same way. So for example, I should go one more time here, back to our balance sheet. Right? I'm taking a flyer, but when cash and cash equivalents went down from 1421 to 545, right? What's the change there? Right? It's $876,000-ish dollars. Right? I'm sort of eyeballing that. Yeah, usually 878. Yeah, usually that's explained right here. So really, a huge part of the statement of cash flows is to show you exactly how the breakdown is of, well, how did the cash move from the year before to the year after? And this statement here details how it moved from the year before to the year after. And I would tell you here, it looks to me like the difference, I think it was 876 versus the 878 here, is that it's somewhat conventional for any exchange rate effects here to show themselves directly on the statement of cash flows. That's pretty high level stuff and not something that I tend to ask about so much. But that explains kind of that last $2,000 gap, and I had sort of not seen it as much at first. There's different ways, and different books will do different things in terms of calculating a free cash flow. The most common type of free cash flow, total cash flow or free cash flow, final bottom line that I like to think of, kind of combines all these concepts here from slides 31 as well as slide 32. Now, I'm actually more of a kind of a fan of this bottom line approach from 31. The book discusses some different breakdowns of these different things. Right? So to me, the best measure of free cash flow, right, it's your EBIT, your operating income-ish, right? Times 1 minus T, you got to pay the taxes on those, plus your depreciation, minus your investments, right? Also known as capital expenditures, right? Plus your change in net working capital. Right? That's to me my favorite breakdown of this sort of thing. Your net working capital is things like, if your accounts payable go up, then it makes it look at first blush like, you've had more sales, or excuse me, it's at first blush, if your accounts payable goes up, you find that to be a bad thing. But the reality is, if you haven't paid cash for it yet, then that expense should not be showing up as impactful on cash. So you kind of take that thing out. But on the flip side, you don't get cash credit yet for accounts receivable when you haven't actually pocketed the cash. So the net working capital piece of this overall puzzle is designed to kind of, again, bridge the gaps between accounting and actual cash. So again, some of these are okay, but again, the book shows you some different possibilities. on these. Traditional accounting data does not really deal with stock prices. A company might mention, you know, if the fiscal year ends on, say, December 31st, some companies might have a note like, hey, our stock price on December 31st was $62, right? But there's no really use or need for stock prices anywhere in the accounting or bookkeeping world. So as a finance person, since we care a lot about maximizing value, it's typical for financial analysts to come up with other things that sort of keep an eye on the accounting items discussed, but also have a real nod at what we care about most, which is value. Right? Market value added being one of these. The market value added is just your market value of equity, which again is how much would it actually take to buy up all the shares, the number of shares outstanding, times the price that they're each worth. It compares it to that book value of equity. It says here common equity for common equity, right? But it's showing you, okay, well, the actual people are really willing to pay this much at the going market price to buy up the company. Accounting-wise, we're only worth this. So the value, the incremental, the difference between the two is known for that reason to be the market value added. Okay. Economic value added. This is a little more subtle and tricky, kind of in my estimation. We're really trying now to still kind of talk about profitability, but after also accounting for the dollars, the effort put in from investors. Right? So there'll be some good example problems to do together on the calculation here, and it's not so bad when you actually have some practice on this kind of thing. But it can be, I think it's a little more weird and a little more tricky than the market value added concept. You're still talking about your EBT, right? Your EBIT times 1 minus T is your accounting, like pre-tax profit, right? But now we also got to factor in or not take credit for the financing that we've gotten from capital, right? And so this will make some more sense when you have deeper cost of capital lecture here in a matter of probably weeks, but it'll be kind of thing. That will shed some light, but it's taking into account the fact that, hey, we want to be cognizant of, well, how many dollars did our investors put into this stuff? Because if our investors put a certain amount into this stuff, then the actual gain that came out of doing what we do operationally is going to seem really different when our investors supplied tens of millions of dollars versus nothing. But given that the MVA actually includes a comparison of value now compared to the the buy-in value or the grand total of retained earnings increment over time, we're sort of in this weird situation where the market value added includes everything, right? But the economic value added is more period specific or period sensitive. So what's ahead, right? Well, I'm mostly now, this is still, it's not exactly intro anymore, but it's still been sort of a focus on just reminding you of basic layout of financial statements, showing you a few terms, calculations, generalities, but kind of wanted to give you a little bit of a bridge to what actual company financial statements are like before we try using and valuing more of the inputs, because we will indeed get a lot of the information that we need for many of our calculations from financial statements, especially income statements and balance sheets. Those are the cost of, the cash flow statement can be useful as a bridge explaining the change in cash amounts, but there's no doubt that the balance sheet and income statement are our primary ones. The next section, we're going to start looking at some financial ratios and taking a little bit more of an analysis sort of shine on our companies. We're going to get some better feels for things that we might start to believe about companies based on the impressions of their financial statements. So a lot of that will come with time and practice, but if it's been a while or if you've never done it, it can be really useful to take items from the financial statements and use them to gain quick impressions about companies. Now, those impressions are not always necessarily correct. You're taking a shortcut by only looking at some specific pieces of your financial statements, but in terms of an efficient time-saving tool, it's certainly something to consider, and that's why it's a relatively good first place to really think about company analysis. And our next topic. A few things for review, as always, that we like to close off with. You want to go back and sort of consider this presentation and or your textbook for the full treatment of these topics. As always, my goal in presentations is to try to highlight which parts of the textbook are most important of all, with an eye knowing that many chapters are 40, 60, 80 pages long, and that it's an enormous amount of reading to cover, along with practice and other things if you're going to excel with the coursework. So if you're looking for kind of a shortcut, hopefully, to help you with the digestion of the reading, that's the goal of the presentations. It's also the goal of practice items for you to do, a chance to sort of say, hey, if I get this right, great. But if I don't get this right, then maybe that really is the place to turn to the book for a fuller treatment of an issue, or to go back and review slides and presentations that go with them, sort of thing. All right, going to sign off for now, and we'll catch you guys again really soon.